This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial. Joining me today is Caleb Doane, their Vice President. Good morning, Caleb.
Good morning.
How's it going?
It's going well. How are you doing?
Good. Okay, so the last time we spoke about how the interest rates are being cut nationally, and now we're going to talk about the fallout of that, or really how it impacts people's individual accounts.
Yeah.
And I know that this is a question that's on so many minds because it's like, okay, how do I gain a benefit for what's happening nationally?
Right, exactly. And over the past couple of years, we've seen just millions and millions of dollars flow into certain products at your local bank, like specifically CDs and like high yield savings accounts or money market accounts, because interest rates have finally been attractive.
Yeah.
You know, prior to 2022, people were getting 1%, 2% on CDs, and so it almost wasn't even worth it. People were just kind of leaving their money in their checking account.
Right.
All of a sudden, when you could get 5% on a CD, people were saying, that's pretty good, of course. And so people were investing in CDs. Now those are starting to mature and come due, and people are kind of faced with this decision, do I renew that CD or not? Because interest rates have started to come down, and so they had previously gotten a 1-year CD for 5%, it comes due, and now the percentage rate that they're offered is a lot lower, and a lot of times the maturity length is a lot shorter too. So they'll say, hey, you can renew this for 4.5% for 6 months, or if you want a full year, we'll only give you 4%.
Right. And so since we are talking about CDs, let's get down to the basics in case someone's listening and they're like, what exactly is a CD? It's like the magical world of banking. Like, how do these products really work, right? A certificate of deposit is a CD, and kind of explain how it works for someone's account and why they would actually choose that.
Yeah, so you have a certain face value that you'll buy. Let's say, you put $100,000 into a CD. You put $100,000 in, it has a stated interest rate, and typically that interest gets paid, monthly, semi-annually, maybe it just gets paid at the very end of the term. And there is that certain term associated with it. So the CD is good for 1 year, for 2 years, whatever it might be. And so you get the interest as you go along, and then at the end you get all of your principal back as well.
Right.
So you put in $100,000 for 1 year at 5%. At the very end, you'll walk away with $105,000.
Right. Okay. And really the point is, if someone has money that's in their savings account, that's just sitting there, right?
Yeah.
For no reason, your money's sitting in your savings account, and then perhaps you would like to do something more with it while it's sitting there, but you don't want to fully maybe put it into an investment account.
Right.
This allows for you to have kind of shorter terms, because the shortest CD is what, 3 months?
It kind of depends on the bank.
Yeah.
But yeah, 3 months is oftentimes what we'll see as kind of the shorter version of that. Sometimes people set money aside for a specific, big purchase that's coming up. They know that their daughter's getting married in a year, and so they'll buy a 1-year CD, and when it comes due, they're going to use that money for that purpose. But of course, now people don't necessarily have access to those high interest rates anymore, and so they're deciding, do I even want to renew the CD? Do I want to look for a different investment that can still get me that same yield? And so that's one of the things we've started looking into.
And so what would be an alternative for someone? So let's say they're like, I'm not going to deal with the CD right now. What else should they consider?
Yeah, so it certainly depends on the level of risk that the client wants to incur. If they want to keep something as low risk as possible, similar to a CD, we've talked before about what are called MYGAs, multi-year guaranteed annuities. That allows you to lock in the high interest rates that we have right now for a certain period of time. So maybe you can get 5% for 5 years. And so you get that 5% every single year. Doesn't matter if interest rates change over the course of that 5 years, you've locked it in right now ahead of time. But there are people that might want to move up on the risk scale a little bit too. So maybe they were getting 5% interest on that CD. There are stocks that you can buy into that pay a 5% dividend.
Okay.
And so that still generates that same yield that somebody was getting previously, but now you also have the ability to move up with the stock market. With a CD, you pay $100,000, you get your interest, and you get that $100,000 back at the end. With a dividend stock, let's say, you buy $100,000 of it, you're getting that 5% dividend, and that $100,000 itself has the ability to appreciate or also depreciate with the market depending on what it does.
Interesting.
So it's a little higher risk, but it's also higher reward. And for those people that maybe don't have a big expense that they need to spend the money on, and instead they're just trying to get that extra return, the dividend stocks could be a good way to go.
That is interesting. Yeah, it's almost like that risk of like, okay, playing that game, the gamble of it all. It's like, what are you willing to sacrifice? Are you willing to put a little bit more for a bigger return? And one thing that's important too about the CDs is that you can surrender them, right? So you don't have to you may get like a 10-year CD, but if you do need access to your money, you like pay a fee or something, or you sacrifice, you surrender the interest on it to get your money back. So it's kind of more low risk, how you're saying.
Yeah, certainly. There's always kind of that liquidity risk a little bit when you're buying into a CD. Usually you can get out of them early if you need to, but like you said, sometimes there's a fee or sometimes you lose a little bit of interest with that too. With money market accounts, one interesting thing with those is that typically the interest rate is fully variable on those. And so maybe when you put money into that money market account, it was paying 5% a year ago. You're not necessarily going to get a notification that they're changing the interest rate on that, especially if they're lowering it, right? They're typically not going to advertise that. So it's really up to you to make sure you're doing due diligence on that and going back and saying, hey, what's the interest rate now? And they might say, hey, it's actually only 3% now. And so now you just need to make that decision. Is this still the best place for my money to be, or is it better elsewhere?
Yeah, so we got to stay vigilant.
Yeah, exactly.
With our funds. Okay, well, thank you so much, Caleb.
Yeah, absolutely.
And if you would like more information about Foster Financial, we'll have their phone number listed below for their complimentary consultation, and I'll see you after the break. This segment sponsored by Foster Financial.